Welcome to the daily update, where I'll go over the action in the market for Monday, September 8th, and we'll see how things look for Tuesday, September 9th. Okay, kind of a sleepy day, but after Friday with the down day, we saw some buy the rumor, sell the news when the employment report came out on Friday. We were leaning a little bit more negative, but after Monday's slight advance, we're leaning a little bit more positive. Overall, we're just not seeing an awful lot of conviction in the short term. The market continues to be rather lethargic. Now, we're going to get a lot of inflation data this week. We're going to get PPI later in the week, as well as CPI, and we're going to get the most up-to-date jobs data that we get, the weekly and continuing claims. So we'll see if the market uses that to develop some kind of a conviction. But we're still looking positive on all three time frames. We're above long-term resistance. We're just not showing an awful lot of follow-through that is convicted as prices tend to be holding up. And that's a pretty good thing when the market loses its conviction but still hangs on to the majority of gains. We're still above short, intermediate, and long-term moving averages. And earnings are still looking fairly good, the projections going forward, but we're also in a potentially weak seasonal time. Now, we were in a weak seasonal time in August. That didn't happen. So far in September, it hasn't happened yet, but we're still at the early stages of the month with a lot of variables out there as to what can actually drive the market and turn sentiment either more positive or negative. Right now, it still continues to be neutral. Okay, so right at the open, we had a higher open. It wasn't much of a gap, just a higher open above the daily pivot at 64.86. And then we actually got above 6,500. Then, once we hit that level, we declined back down to the daily pivot. And then prices remained in a pretty narrow range for the rest of the day between the daily pivot and 6,500. And we closed just a little bit below 6,500. We were up 0.21%, so less than a quarter of a percent as far as the change by the time we went into the close. And we were just a little bit above average with volume. So we're seeing that picking up a little bit. All last week, after the holiday shortened week, we were below average until Friday. And then we went above average on Friday. We're just a little bit above average now after Monday. So maybe that is starting to pick up a little bit. And as I said, positive on all time frames. Interest rates continue to drop. Now, there are two kind of going scenarios right now that, okay, the Fed's going to come in and cut rates, but why? And I've been pointing this out over and over and over again because we have to know the context of that. Are they coming in and cutting rates because they want to help the economy improve after it's kind of slowing down a little bit? And inflation seems to be fairly under control. We'll get some inflation reads this week. Or are they coming in and cutting rates because there's more weakness under the surface than what we're seeing, as evidenced by the much weaker than expected employment report last Friday? Right now, the market is pretty much anticipating that, okay, even though we're seeing some weakness in areas, we're still doing okay with the economy. As of right now, inflation doesn't seem to be a problem, but that'll be updated this week. And you have another camp that's saying, no, we're getting ready for the economy to actually be more negative than positive, and the Fed might be cutting rates because of that, and that changes the overall context. But in the meantime, we're still seeing interest rates going down. The dollar is still in a downtrend, which is helping stocks, but we're not seeing an awful lot of conviction to the upside right now either. All right, so some comments. It was what we call an inside day, where the open, the high, the low, and the close, the whole bar for Monday stayed inside of Friday's open, high, low, close bar. Not necessarily a huge deal, but it just reinforces this idea that there's a real lack of conviction. But if anything, it's leaning more positive than negative. And mega caps, that's kind of what helped things stay together in Monday's session. And then the one thing I really like about the S&P, and I have a video on YouTube and Rumble that you can go through this, and it's a section of the course that I teach. Why do you do the S&P 500? Well, because there's built-in criteria in the S&P. And some people see this as a slam. I see it as an advantage because since that criteria has to be met for stocks to be in the S&P 500, some stocks are taken out and other stocks are added into that. And that just makes, I mean, it's not pure quality, but at least there's a set of criteria that these companies have to meet to be included in the S&P 500. And Robinhood Markets and App Lovin, okay, apparently they're going to be added to the S&P 500 on September 22nd. And so their stocks really rose on that. Not because of great things necessarily within the company, but money managers out there, mutual funds, ETFs that mimic the S&P 500, now they have to go in and buy that stock. And so that t- became a lot of buying for those two particular companies because now they have to add that as to their overall portfolio. Now, on a short-term basis, a few things. We're seeing both the CCI 14 and 20 looking a little extreme, but our Stochk RSI, the Williams percent are the other charts that we look at, they're just kind of floundering around, not really showing much conviction. And then our stochastics chart, which tends to be on there anyway, pretty much all the time. And then the Chaikin oscillator. Now it's actually turning more negative. We declined in Monday's session and we're dropping below the moving average, but it's still giving us a high reading. And the Sean trend meter is still looking rather extreme. And I haven't been able to really change this overall scenario as it applies to the Fed. When I originally came up with this scenario, they're worried about employment on one side going down and they're worried about inflation on the other side going up. That hasn't changed. That's what they're still fixated on. We are getting more dovish comments coming out of the Fed that we'd be open to a rate cut. And the market has pretty much figured 99% chance that there's going to be some kind of a rate cut when they meet next week. And so that's not the variable. The variable is by how much. And even when you look at the percentages between a quarter of a percent and half a percent cut, we're pretty much locking in the quarter of a percent with then an anticipation that there'll be another quarter of a percent cut in October. Okay, then the dollar was down. That helped keep stocks at least in a positive light. And interest rates were also down. We're getting down to 4.05%. Now, we were really dropping. Now, and one explanation for this drop in rates could be folks are worried about the economy. And so they're trying to lock in higher yields now because if the economy is starting to see some problems, then we're not going to see those higher interest rates for a while. And so they want to get into bonds now to get that higher yield, lock that in as interest rates continue to fall. That's one of the takes that you can see here. Another one is just that, okay, maybe, the trend for interest rates has been down and we're just kind of following that trend for the time being. All right, and we're still neutral with sentiment. And as I pointed out over the weekend, it's like we had set an intraday all-time high on Friday with the S&P. Didn't do it on Monday because it was an inside day. And here we are at neutral. We should be like 70, 73, 74, 75. We should be much more positive as it applies to sentiment, which this could actually end up working in the market's favor because the market's not overly exuberant right now, according to this measure that we use. So that means there's more room to run to the upside. On the negative side, it's like people don't trust this and they might not be as willing to come in and buy. So it's kind of a positive and a negative that you can take away from that. But this is not where we usually see sentiment with the market, the S&P anyway, where it's at right now. We're still positive with the trend. We're not trending in the short term. We're seeing a weakening trend in the intermediate term, and we're not trending on the weekly chart either. That's also coming over as a lack of conviction. And then since we had an update, the bias is positive. Momentum, I've switched back over to mixed. After Friday, it could be like mixed to negative. After Monday, it could be mixed to positive. I'm just keeping it at mixed for right now to take the last number of days together. All right, then we just had consumer credit coming out, and there was an increase of 16 billion, which that's a little bit of a concern when you see folks having to use their credit cards, maybe to buy groceries or gas or just to do everyday things. And that's not a sign of real economic strength when we see a real increase in debt. And they expected it to be up 10.5 billion. It was up quite a bit more than that at 16 billion, or the last reading actually had us down 4.3 billion. And here is a chart of that showing how the on a year-over-year basis, though, we're declining. So that's still looking a little bit more positive, and we have been declining pretty much as we were going through the bear market in 2022, and it's been on a downward trajectory. Then it started to come up, and now it's decreasing a bit here. But when you look at it on a month-over-month basis, we were actually negative last time where it was positive here. It's not a huge deal, and we're not seeing any change to the longer term trend. But if this continues to go up on a month over month basis, this will start to go up on a year over year basis, and that could be more negative. All right, then here are some Isabel Net blog charts. So the forecast for the S&P 500, this is Goldman Sachs. They are predicting or forecasting, which I don't do, but people love this. Even if you're wrong, they still want to hear a forecast. And they're forecasting that the S&P is going to go up. 12 months from now, it'll be at 6,900. I read another report right before starting recording here. The earnings are looking good from another perspective as well, which would also put the S&P at about this same level. And that's because earnings are going up too. And the other article that I read also was again looking pretty positive when you're looking at earnings. But this is the trailing earnings per share here. The article that I was reading looks more forward, and both of them are looking good, and that's what drives stock prices. And we get this all the time, and something that we just have already known, but seem to have charts pretty much every day to show this. This is looking out the next 12 months, where you have the NASDAQ 100 at 28, 10, 15, 20. That's the scale you want to be on, and we're well above 20 at 28, where this blue box here, that's more the sweet spot for this. And then you have small caps by the Russell 2000. Now, again, this contradicts another chart that I look at and go over in the weekend video. This is the Russell 2000. The PE ratio that I use over the weekend looking forward is the S&P 600, which is another small cap index. That's down between 15 and 16, where this one's coming in at 24. Then you get the S&P itself all taken together. That's still expensive. And then the equal weight, because it's a lot of the really big stocks that drive the value of the S&P itself, that's more fairly priced, and then mid caps are more fairly priced as well. But and again, as I say, we don't use this for timing because we've been seeing these same charts for 2, 3 years now. And so if you make decisions based around valuation, you're going to miss out on a lot of gains. That's why I also incorporate heavily technical analysis. What's going on with the charts? And that gives us the clues to what's actually happening. Because as far as valuation, it doesn't seem to matter, but then at some point it will. But we don't really know when that's going to be. All right, then our commodity strategists see further upside in gold. Okay, yeah. Goldman Sachs again, gold's been going up, and so they see it to continue to go up. If it was going down, they would continue to see it going down as well. But you got a lot of the gold folks, which the few that I've kind of keep a distance. I wanted to say close, but no, it's really more of a distance. When I kind of look at their headlines and look at the main things that they're saying, the folks that really love gold, they tend to be very bearish on stocks. Well, they've been very bullish on gold for a long time now, and they were all excited when we broke out earlier in 2025, and now they're like really excited, and they're just sure stocks are going to go down. Okay, and then stocks are still beating bonds. You look at the post-pandemic rally, it continues scarcely without an interruption. This is the TLT. This is the 20 up to 30-year bond based on price, and stocks are still outperforming. And I go over that in the intermarket analysis video over the weekend. Equity positioning here, seeing a little bit of a leveling off here with the systematic approach. That's where you follow a system. You don't really concern yourself as much with what's going on in the market. You just follow a system. Then overall, these are people that can pick and choose. Where discretionary, that's where you have a little bit more control. And this is trailing off a little bit here. And because the systematic approach, that works well when the market is in an uptrend and keeps going up because you get those high up days. You don't really have to analyze things as much. If things are still looking positive, then you tend to perform better. The discretionary tends to perform better. You see how it held up when we were really going down in March and into April. That it was going down too, but it was going down less than the systematic approach. So this tries to take the different broad categories of approaches and see how they've been performing. And then this is what I've been talking about with the context. Rate cuts bullish for equities outside of a recession. Well, right now the market doesn't think we're going to go into a recession, but because of the drop in interest rates that we're seeing, there's there at least some of the smart money is entertaining the idea that we might go into a recession, and that changes the context as to why the Fed is cutting rates. So this gives you kind of an idea of how do we perform going up to the rate cut, and then whether we're in a recession or not. If we're not in a recession, we do better. If we are in a recession, we do worse. That's why I keep hounding this over and over and over. You have to know the context behind the rate cuts. And chart of the week here, job openings per employed. Now this is going to look pretty drastic here, but if you look over on the right-hand side, this is one person, one and a half people. Yes, I would like to hire half a person to do this job. And then it gets up to two. So because there's a pretty wide scale over here, it makes this chart look a little more drastic. But these are the JOLTS job openings divided by the number of unemployed people. And it's actually been coming down where after the pandemic, we saw it. Folks were having a really difficult time filling jobs because they were getting stimulus checks, they were getting benefits from the government. So why go out and get a job? Well, that started to taper off, and we're seeing more of a decrease down here. So that there tends, at least according to this chart, there's one job for every unemployed worker out there. Okay. And then federal government employment dropping at its fastest. Now, you remember Doge? That seems to have dropped out of the pop news that everybody was fixated on for a while. But there's a lot of cuts that are happening right now, and so we're seeing a real drop off in government employment because that was the fastest growing area leading up until a new administration. And labor market expectations. And this just shows jobs finding is the risk in the labor market. So it's like people aren't losing their jobs, but the folks that do lose their jobs are having a more difficult job or more difficult task finding a job. And that's kind of what's showing here. According to the probability of losing a job remains relatively low. However, if you do lose your job, finding a new one has become more challenging, a level never before seen in history. So we're breaking new ground here. All right, then fund flows. Last week's fund flows into large cap discretionary. And I've been also trying to point this out because it was a year ago in 2024 when going into the end of the year, the discretionary sector was the best performing area of the market. And we're starting to see that now. Now, we don't know if it's going to continue, but it's been doing good. It's one of the ratios that we look at, growth versus value, discretionary versus staples, that actually is holding up quite well. And folks are starting to chase that a little bit. They're starting to get more into that area of the market. And then Russell 2000 against all-time highs. Okay, the Russell 2000 has now gone 960 days without reaching a new all-time high, and it has been lagging. And you could say that with the mid caps and as well as the different small cap indexes that we look at. But now small caps have been seeing a little bit more favor. Not an awful lot of follow through on Monday, but they had a pretty good week last week, and were one of the small caps and the mid caps were the best performing areas of the market. And index breadth, the takeaway is simple. Across multiple time frames, most major indexes are tilted towards strength. So you look at above their 20-day, 50-day, 100-day moving averages, and this is what I use to determine whether we're positive or negative. And when we're above that, that tends to be more positive for the market. All right, then sector returns. If you break all 11 sectors down, how are things going? Here's the prices return here over here. Earnings per share growth, some are really looking pretty good. And this is tech. This is the big growth area. And then the PE multiple, how's it going up as well? This one's actually been coming down according to this one. And that's where we get the PE ratio is more the valuation when we talk about the market as expensive. Okay, so kind of a ho-hum day overall. We did have a positive open above the daily pivot. We got back above 6,500, but we didn't get back to the all-time high that we set on Friday, and which then we went down after that. Then we drifted back down to the daily pivot, so the support level has been holding up, and we closed a bit up above the daily pivot, but still below 6,500. Intraday, not seeing any real movement. Right before I started recording, I was looking at the initial overnight session here. Saw a little bit of a drop off as things were closing, but not a big change. And we didn't see much of a change when the futures opened Sunday evening, East Coast time here. And then we saw more of the strength actually coming in as we worked our way into the session. And then we're seeing, even though it was a subdued day, we're seeing most of the price action actually coming while the market is open. And this is improving, even though the blue line's tapering off a little bit. We saw a little bit of late day weakness here on the intraday chart, but the blue line being above the red line, that's when growth is outperforming value intraday. And we also saw a drop off here with S&P growth to value intraday, but this has been improving. It's a little bit discouraging that we saw this coming down as we were getting closer to the close. So our end of day charts growth was down, but down quite a bit less than value, where it was up a little bit more for the mid caps, and then small cap growth was unchanged, where value was up. Okay, what's how come I have two charts here? This was for Friday. And so seeing a little bit of an improvement here with the S&P growth to value ratio, but we've been drifting off as the index has been going up. We want this ratio to continue to go up to be more positive. A little bit of improvement with mid-cap growth to value, but we're still below the 50-day moving average. A little bit of a tick up, possibly stabilizing here with S&P growth to value. And right about the beginning of August, this is when we saw this ratio coming down as the market was at least setting up to be more defensive for declines that didn't transpire. And so if we can continue to go back up with this ratio, naturally that would be more positive. And coming up a little bit with this growth to value ratio, actually peeking our head out of the rainbow, but not back to the previous high that was seen here. And here's discretionary, the equal weight. Now, what that does is that takes Tesla and Amazon and counts them with the same weight in that particular sector. Then including since they're such big companies, they have a really drastic impact on the discretionary sector, where we've been seeing the defensive areas, staples, actually just kind of chopping along sideways. So this is one of the better looking ratio charts that we're seeing right now with discretionary outperforming staples. And large cap growth, a little bit of a lag when I did this over the weekend, but we were actually up here and now setting a new all-time high. That's encouraging right there. And we're trying to turn back up, but we're still below 20 with the short-term ADX, and we're kind of even with the moving average right now, but this is still positive with the green line above the red line. Intermediate term, which is where I focus, trying to turn up, but still below the moving average, but we're positive with the green line above the red line. And we did see a pickup in volume, both in Friday's session and then again in Monday's session here. You can't even see it. It's pretty much right at the moving average. But the green that you see here was Friday, and we were just right on the black line for Monday's session. And then weekly look at sentiment, still leaning over towards the positive side, where the charts that we look at were, and that I follow more on a daily basis, we're in the neutral area here, where we're leaning over positive with this chart and seeing a bit of an increase here, which could be negative. When this red line goes up, that tends to be bearish when it measures legal insider transactions. People that work in companies, CEOs, and are they actually in there buying some of their company's own stock? When this red line goes up, that can often be bearish. And then another sentiment gauge put out by Goldman Sachs. This is tending to lag. We never have gone positive since we really dropped down in last spring with the March and April decline. We have been improving, but it's still below the midpoint here overall. And then stock twits. All right, isn't that a great name there? This is the white line. This is the S&P itself, and as it's actually been performing. And then when we're above this line, that's considered to be red as far as sentiment, and we're actually down into the green area now, suggesting that sentiment is not extreme. But we're seeing that also confirmed with other charts. So we're also still looking okay here with the VIX, below the moving averages, below 20, both with the line chart. We declined just a little bit, and we're also below the moving averages with the bar chart. And just want to keep this in the back of our mind. Typically, when we get into August and September, that's when the VIX goes up and stocks are going down. We haven't seen that start to happen, at least yet. But seasonally, and this could also explain why sentiment is more neutral, because a lot of folks are expecting this to happen. A lot of folks were expecting August to see a decline as well, and that didn't happen. So a lot of times when everybody's expecting one thing to happen, the opposite is what ends up actually playing out. But we don't know that yet. Okay, I think I hit the wrong button here. And we declined here with this fear gauge. A really big drop off with this one, but a little bit of a tick up here with this other fear gauge. A little bit of an increase with the daily equity put call ratio chart. going up with the 5-day chart and going up with the 10-day chart. Now that's taken as more defensive. This could be some hedging going on ahead of PPI and CPI, just in case those reports come in that the market doesn't receive in a positive way. Folks are already hedged. And a little bit of sideways action here with volatility risk premium, but still above the band. So it's still looking okay, but flat with the advanced decline line based on price. A little bit of a decline based on volume in the bigger picture. Still positive. Still above the midpoint here with the short and intermediate term advanced decline ratio. And after Friday, we were slightly above zero. Now we're back down below zero here. So not a lot of conviction showing when we spend a lot of time around the zero level. And a little bit of a decrease here with the smart money indicator. Not enough to turn it negative, but we did decline here with accumulation distribution, but we're still above the advancing moving average. We're right on top of the moving average at the boom indicator, which is more short term. And we're actually drifting down with the 5-day and the 10-day moving average of new highs, new lows. We saw an expansion on Friday, but that didn't come through into Monday. And so we're seeing more of a contraction, but we're not seeing much in the way of an expansion of new lows. A little bit in Monday's session. And we're starting to become flat here. This was one of the stronger looking smart money indicators where we were going up with the histogram. We saw a decline in Monday's session, and that's turning the red line flat. So we would still default to positive with this, but it's not full blown positive since it's showing some weakness. And this is where we're still extreme with the Chaikin oscillator, but now we've dropped down below the moving average. So we saw a little bit of weakness coming into our smart money indicators where they were looking a bit more positive, especially after last Thursday. And even with the decline on Friday, they were still hanging in there and looking positive. It's still positive here with the vortex. The green line's above the red line, still above the moving averages with all of our advanced decline lines. And trying to show here where we're breaking out a little bit with the NYSE advanced decline line. We're not really seeing that on the S&P, but we are seeing that here on the NYSE. And not much of a change with those stocks in the S&P above their 20 period moving averages. And I've been trying to point out too, as we've been going up with the S&P, we've been seeing a series of lower highs here. That's a negative divergence. And at some point that may matter. It doesn't seem to matter at least yet, but we are seeing a longer term pattern that could it's just something we need to pay attention to there. Also seeing a bit of a negative divergence with the 50 period moving average study, even though it ticked up a little bit in Monday's session. Not really seeing that here with the 100 period moving average study, just kind of drifting along sideways. And so that's longer term, meaning that we're still hanging in there according to this chart. And a little bit of a decline, but as I was also pointing out over the weekend, a series of higher highs as we've been coming up out of the April lows, but not an awful lot of conviction currently. So still looking okay here. We were up just a little bit on the daily chart, but just a lot of choppiness right now. We see a little bit of an up move, then a little bit of a down move. Excuse me. We're not really seeing any sustained trend either up or down, and we were just a little bit above the moving average with volume. A little bit of an improvement with the 20. We actually declined a little bit with the 50 and a little bit of a decline to flat with the 200 period moving average on the S&P. Slightly above the midpoint with the Stochk RSI. And we're just a little bit below looking extreme now with the Williams percent R. And these are the two charts but they're not showing strong conviction. I just put them on the list when they go above 100. And this is the CCI 14 and the CCI 20 and right about at the midpoint with the force index. And you can see these Keltner bands are starting to get closer and closer to each other. And that's just showing a lack of conviction as well. And we're starting to get a little more extreme with the short-term stochastic, intermediate short-term stochastic. These are positive, where we're still extreme, but now below the moving average, and we continue to be that way with the long short-term stochastic. And with the up day looking okay here, not great, not a lot of conviction here, but we're still tending to go up with the blue line and the green line. Yes, I know my colors. And this study is based on 20 periods, which I consider to be short term. We want to keep an eye on the 20 period simple and exponential moving averages. We broke below that last Tuesday when the market gapped lower, but then we quickly got that back. And in Friday's session, when we declined, that ended up providing support, and we closed up off of that. Well, because of the inside day here, we didn't get close to that, but we want to keep an eye on this. And we're just a little bit into the +2 channel with the standard deviations chart. That's positive. Declining a little bit, but above zero with the balance of power. Still positive with the go, no go, darker blue bars. Still above the midpoint with the highest high value. We're on day 89 now of this trend that started back in the beginning of May with the Landry light system. Also still in an uptrend with the proper order. Still looking negative though, and seeing two red dots here. This has been actually registering some weakness even as the S&P has been going up. So that's a bit of a negative divergence there. When the TTM squeeze turns to the darker shade of blue and is declining, and just trailing along, barely above zero here with the ease of movement. Still looking okay with the Arun. The green is outnumbering the red. Excuse me. And greener buyers, a little bit of a drop off there, but also a little bit of a drop off with the sellers. So the difference between the two then is looking more positive. And I have to pause this so I can get a drink here. Yeah, you gotta love it. I call them take one videos because I learned a long time ago to my best form of analysis is when I just hit the button and then I can go from chart to chart to chart and I can stay more in a zone when I'm looking at things that way instead of trying to break that zone that I'm in. And so that's why you get me stumbling over my words and clearing my throat sometimes. But the Arun is still more positive overall. And we're still negative here, though. This is the McClellan oscillator for the S&P. Came down a little bit, even though the S&P was up, and we're still below zero. So we are declining based on price. Not a lot of conviction here. We're seeing a little bit more conviction here based on volume. And this has been a concern. And even when we were going up last week, we were still seeing a divergence here, a negative divergence with this indicator going down. But we're more positive when we look at the broader market. Now, we were flat with the McClellan oscillator for the NYSE, but it's above zero. And we're really choppy here, but now starting to go back up with the summation index based on price, pretty much flat to slightly going up based on volume. And now we're seeing more confirmation here. We were going up with the swing and trading oscillator after Friday. Now we're going down. And we were going down with the swing and trading oscillator based on volume. And we're continuing to go down now. So these are both going in the same direction. That's more negative. And still not seeing really any kind of change here with momentum. It continues to drop off with the PMO. A little bit of a better hold up here with based on price, but we are seeing a decline here based on volume. So a little bit of a tick down below 50 with the PMOs that are rising, a little bit of an increase right at 50 with the buy signals, and flat but above 50 with the PMOs that are above zero. Positive with the Elder's Impulse system for the S&P, positive with the parabolic SAR, negative with the short-term slope oscillator, negative with the MACD, negative in the short, intermediate, and long term. We're just drifting lower here. And as the S&P has been going up, we've been seeing a lot of negative divergences that are confirming each other, and that's a concern. But we could get a solid move to the upside that could rectify all this. We just haven't seen that yet. And the copy curve continues to be negative as well. The Sean trend meter is positive up in this green area right now. And we had dropped below 50 with the money flow. Now we're back above 50. That's positive. Declining, but still above 50 with the ultimate oscillator. Still above the moving average with on balance volume. Still above 50 with the intermediate and short-term RSI. Again, another negative divergence. We've been going up with the S&P. We've been setting a series of lower highs here, both in the intermediate and short term. Looking good here with the trend short term. Above the green fluorescent line, that's a 10 period simple moving average. And the green is above the orange, which is above the blue. That's positive. And still looking okay. A little bit vulnerable here, but the red line and the blue line, for the most part, are still going up. We would like to see the red line see a little bit more conviction since it moves faster. But when you look at this just for what it is right now, we are still positive above all the plotted moving averages. And we did come up a little bit. In fact, we were actually unchanged, but we're still negative with the bullish percent index here. We haven't quite seen a real convicted move above the moving average. But when you look at the NYSE bullish percent index, that's going up. But we're improving, but right at 50 with the NASDAQ 100 bullish percent index. This is not showing leadership. If we were really looking more positive right now, we would see a lot higher reading than what we're seeing right now, not more at the neutral area. And then the Pring bottom fisher rolling over a little bit here. That was generated back in about the middle of August. I don't make decisions based on this, but since it's generating a signal, I wanted to show that. And then this is what I've really been focused on here. We closed above this R1 pivot point on Friday. We've been hanging out around this pivot point, and so far we're above this pivot point. But we have to wait until Friday to see if we're going to be able to stay above this pivot point. Now, as I also pointed out, the longer we stay around this level, potentially the more positive it can be. Because if you look at other times when we hit one of these pivot points, that's where we hit and turn and ended up going in the opposite direction. Where here we've just been kind of hanging out here, so we'll have to see if we're going to be able to break above this even more. And also at the upper end of the trend channel, that could be some of the reason for the lethargic action that we've been seeing there. But we are positive with the Heiken Ashi. The Kagi chart is positive, the Renko chart is positive, and the three-line break chart is now back to looking more positive. Long term, still holding up. Not really seeing much of a change here with the 150 and 200 period moving average studies, but they're positive. And positive on all time frames across all the different indexes. Commodities are still negative in the short term. The dollar is negative on all time frames. Bonds have really been just going up based on price as we've been going down based on yield. And then this is encouraging here. We have tech, discretionary, and communication. Those were the three growth areas that were up. We saw utilities getting smacked, and then staples were down, energy, healthcare, financials, they were up just a little bit here, but more the defensive areas, they were negative, were the growth areas and even cyclical areas that tend to go with the economy. They were a little more positive. So we had energy with a bearish MACD crossover not too long after the open. We did get above 6,500 with the S&P, but we didn't close there. We set a new all-time high here with the Nasdaq, but we're off of that a bit. And so a lot of red, but we did see green with Microsoft, Nvidia, but Apple was down. That had a great week last week. Google down a little bit, Meta down a little bit, Amazon up, Tesla down. Not showing a lot of conviction here. The Dow's just kind of going along sideways currently. The diamonds are neutral. And we set the intraday high, but we closed off of that here with the NASDAQ. And we're still positive though with the Elder's Impulse system for the NASDAQ. Not back to an all-time high yet with the NASDAQ 100. And if you go back to the last spring or so, in the intermarket analysis video, I do a ratio of the NASDAQ 100 to the NASDAQ. And the NASDAQ 100 has been drifting lower. It's been doing good by itself, but it's been underperforming the rest of the NASDAQ, which could be negative because you want the NASDAQ to take a leadership role and it's not. Or that could be positive, just meaning, well, it just means that the NASDAQ, which is a broader index, is showing more broad participation. And we're still positive with the Elder's Impulse system for the Qs. We're improving, but still below the moving average, and the oscillator continues to decline when we look at the momentum for the NASDAQ 100. And not much of a change, down just a little bit with small caps, with the S&P 600, where we were up 0.2% with the Russell 2000 small caps. This is looking a little bit more positive here. And going from positive to neutral with the small caps with the Elder's Impulse system. Mid caps virtually unchanged after they had a good week last week, but still positive with the Elder's Impulse system. The Wilshire kind of back here to really close to being a new closing high. Not an intraday high, but possibly a closing all-time high. And still looking good here with this other broad market measure, the total U.S. stock ETF. Financial sector virtually unchanged, still above its 50-day moving average. But this is the concern. We were improving with the ratio between the financial sector and the S&P, and it's not happening right now. And this is a little bit of a concern. We've been seeing this drifting lower. We thought it was improving. Now it's starting to weaken again. And the FANG index, another day, another new all-time high. When the mega caps lead, this index does really well. And so Apple was down 0.75%. We had Amazon up over 1.5%. Google really benefited last week with the court ruling that they can continue to use Chrome. It helped Google and Apple. Possibly a little bit of profit taking going on in here. Microsoft still down below its 50-day moving average. Meta still above its 50-day moving average. Nvidia up 0.75%, but not quite back up to its 50-day moving average. Tesla bouncing around all over. It was down 1.27%. And Netflix is hanging out around its 50-day moving average, which is pretty much turned flat to slightly declining now. A little bit of an improvement with the shorter term correlation between US and world stocks, and we're flattening out with the longer term correlation. And we bounced a little bit here with oil. We got down into the 61 range. Now it's back up into the 62 range. Still in a downtrend with the dollar, which has been helping stocks and still continuing to drop down here with the 10-year yield. This is pretty big. This is a pretty big drop. We were already going down, and then the real big drop came after the employment report on Friday, and then we're continuing to drop here in Monday's session. So we're really going up. Now we're starting to become overbought here. The RSI is above 70. We're looking pretty good from a momentum perspective, but at some point, folks are going to want to come in and take some profits, and that could reverse what we've been seeing. And so improving, but still below a declining moving average with the cues to S&P. Discretionary to S&P, that's a stronger looking area. A little bit of back above the moving average when we compare large cap growth to value. So we're above the moving average with the large caps, coming back above the moving average with the mid caps, still below a declining moving average, even though it's improving with the small caps. And we're starting to see a little bit of a breakout here. Utilities were down, the S&P was up, and we're seeing this ratio is starting to go back up. That means the S&P is outperforming utilities. So then what's our outlook? We're still positive on all time frames, and we're still above that longer overhead resistance. We're going to, originally I said none, but then I rechecked the economic calendar. We're going to get the NFIB small business optimism. An important report, but not necessarily a market mover. And all the geopolitical things, all the things that the market is trying to digest right now. And then here is where we see PPI on Wednesday, initial claims, continuing claims, and CPI on Thursday, and we'll get consumer sentiment on Friday. And so the really big stuff isn't going to happen until Wednesday's session. Seasonally, we are positive. When we look at September 9th, going back to 2002, this is good for the Dow, S&P, and NASDAQ. But when you look at September, this going back to 1964 has not been very positive. And if you look at all these numbers here, number of different ways to measure this, this also shows that September is typically a weak month. We're just not seeing it yet, and we don't know for sure if it's even going to happen. And then we are in the first half of September, which doesn't perform all that well, but at least it tends to perform positive. It's the second half of September that tends to be weaker. And then this also shows the weak seasonality that we typically see, but we didn't see it in August. So far, we haven't seen it in September. And this also shows that September tends to be pretty weak when you go back to 1950. So we're still looking negative with the McClellan oscillator and summation index for the S&P. Momentum oscillators and the Koppel curve, they continue to be negative. The swing and trading oscillator is now declining based on price and volume. And we're improving with the Nasdaq 100, but it's right at 50, and it's not really taking a leadership role right now. But we were unchanged with the S&P bullish percent index, so we're not getting any worse, but we're not really showing any improvement there. And then the momentum for the Nasdaq 100, and then our smart money indicators for now, I'm still keeping them on the positive side here. The accumulation distribution, that's still looking okay, where we're flat with the Chaikin money flow with the red line, and we're actually turning more negative since we dropped below the moving average with the Chaikin oscillator. And then longer term, we are still positive with our growth of value. We're really hopeful about the discretionary to staples ratio. That continues to look okay. And we're above zero and positive with the NYSE McClellan oscillator and summation index. Parabolic SAR is positive, as is the NYSE bullish percent index. And then ease of movement, money flow, and ultimate oscillator are positive. Vortex is positive. Financial sector is positive, but we're a little bit concerned because it continues now for a number of months to underperform the S&P. And then we do have a weakening Pring bottom Fisher buy signal. And then the longer term special K chart, which I went over in the weekend videos, the weekly chart and the daily chart are positive. All right, and then here are the pivot points for Tuesday's session. They're available on the website and they're available on the YouTube community tab. So our conclusion, positive, above overhead resistance. We're wondering, is that going to be able to hold? Short term, not showing much conviction at all. And if so far, if we've been seeing a decline, the 20 period moving averages have been providing support. Intermediate term, we are seeing some weakness. The bullish percent index, the summation indexes, but we're also seeing some improvements as well. But we're still defaulting to the positive side since we're well above the 50-period moving average, and we continue to be positive in the long term. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.